What is going on, guys? I am Chase, and welcome back to Intelligent Money Investing. Today, we are going to be going over 3 ETFs I'm thinking about buying in the month of May 2018. And this is an important month for me because this is when I'm going to start having more income because I'm going to start my summer job because I am done with school now, so I can upload a little bit more consistently for you guys. But I'm going to have to start having more money coming in more consistently. So I'm going to be really putting in a lot of research as to the companies I want to put in my money to for the summer. And there are 3 ETFs that I'm very excited to grow my positions in this summer, including one new one that I haven't talked about. It is right here, but we're going to talk about that in a little bit. The first one I want to talk about today is going to be VYM. But before we do that, I want to ask you guys, if you could, please hit the like button on this video. It really helps out the channel, helps the channel grow. We've been seeing so many new subscribers lately. It's been absolutely awesome to see, and I hope you guys stick around and enjoy the content. Excuse me. All right, now let's get into this. So the first one we're going to talk about is going to be VYM. This is going to be Vanguard's High Dividend Yield Index Fund. And as you guys know, I've talked about this one before. It's an absolutely great ETF just because I really love the expense ratio on this one. I think this is one of the lowest expense ratios I have outside of just typical S&P 500 ETFs. Like VOO is 0.04%, but that's also a Vanguard fund, while pretty much the biggest ETF out there, SPY, is about 0.07%, and typically with index fund or ETFs, the expense ratio is going to go up depending on how specialized it is and how often it pays its dividend. So this is a quarterly dividend yield, but it also it's fairly specialized, being a high dividend yield. It's not just simply following an index. So but it also does not have that high of an expense ratio. 0.08% is about as low as you're going to get for something that's not a typical index. So I'm very pleased with that, and it's a big reason I want to hop in here. And another big reason I like VYM is that it excludes the real estate investment trust. You guys know I have a lot of exposure to those in SPHD and a lot of other individual stocks that I hold. And with the rising rates environment, I'm kind of trying to wane off of those, like not put any more money into real estate investment trust. So this is a great way to do that. Let's go through its top holdings now. So top one's going to be Microsoft with 7% of the assets. You guys know Microsoft is such a fantastic growth company right now, but it's not just a growth company, it's also a dividend growth company. So it's making a ton of money, it's paying out and rewarding its shareholders, but also growing its business at an incredible rate. So I think it's a great stock to be holding right now. I hold it individually personally, but when this allows you to be diversified but still have 7% of your assets in Microsoft. So next is going to be J.P. Morgan, Johnson & Johnson, ExxonMobil, Wells Fargo, Intel Corp, AT&T, Cisco Systems, Pfizer, and Chevron. I'd be surprised, honestly, if you guys haven't heard of most of these companies. All very big dividend payers, all going to be quality stocks. They are not going anywhere. These are not stocks that are at risk of going out of business. They have very big competitive moats around them, and they're going to be successful for a very long time. And more importantly to you guys, to be paying out dividends to you for a very long time, and hopefully growing that dividend and kind of keep building their business in the long run. I'm sure they will, just because these are like the cream of the crop, best stocks on the market in terms of dividend and dividend growth, I think. And another one we're going to be talking about is going to be DGRW. That one's more focused on dividend growth, while VYM is a little bit more focused on that quality dividend that you don't have to worry about at all. So I think that's a good segue to switch over to DGRW. This is going to be the second position we're going to be talking about today, and this is the one that is brand new to the channel. I don't believe I've talked about it at all before, but I have been excited to bring it on and bring it onto my portfolio. I think right after this video, I'm going to place a buy order because I've got some extra money, and I really want to get in on DGRW. So what this is WisdomTree's U.S. Quality Dividend Growth Fund. So if we look down at the fund objective down here, most of this stuff is just talking about the index that it tracks and the kind of the fundamentals, but the index is fundamentally weighted. It's a fundamentally weighted index that consists of dividend-paying U.S. common stocks with growth characteristics. Fund is non-diversified. So essentially what we're looking at here is growing companies that are paying out good dividends. So let's look at these individual holdings. So these are going to be, so basically when you're looking at this, what you're excited to see is that what you're looking at now for a dividend yield, I don't believe its yield is that high. Let's look for it up here. Yield, yeah, yield is only 1.87%, but what you're really excited about is that potential for the growth in the future. And it's also exciting because DGRW does pay out that monthly dividend. So you're going to get a check every month from DGRW, and as you build that, you can reinvest it quickly. It's really great to do. It's always great to see those monthly dividend checks coming in because it really does make you feel like you're accomplishing something when you're with your investments and just getting back in cash. I personally really like getting dividends, and I'm sure many of you out there do as well. So its top holdings are going to be ExxonMobil, Johnson & Johnson, Microsoft, Apple Inc., Wells Fargo, AbbVie, Altria Group, Intel, PepsiCo, and the Home Depot. So these are really good growth companies with a lot of them pay very high dividends. AbbVie, one of my personal stock holdings, used to be my biggest stock holding before I got into Goldman Sachs, and it took a little bit of a dip. I believe it might be my 2 shares of AbbVie, as you guys can see over here, might be higher valued than BRKB right now. I kind of keep my individual stocks in order of equity value, so I kind of have to do some rebalancing as that goes. But so AbbVie has been raising its dividend very aggressively, and that's why I'm so excited that it's a big part of this fund, 2.5% of the assets here, because their dividend, just since I've owned it in the last probably 9 months, has gone up about 40 to 50%, and that just makes me excited about the prospects of this ETF as a whole, because when I have this, I want to, like, it might pay out like 10 cents a month now per share maybe, but when I want to have it 20 years from now, I'm hoping to get maybe 50 cents, maybe $1 every month per share, because you really want that growth and to be very aggressive, and as it builds and builds, you want to be able to get paid out, like you want to get paid out at a higher rate in the future. You don't just want a flat rate, especially in the stock market. Like if you're investing in real estate, maybe the value of the property isn't going up that much, and depreciation, along as the value of the land, kind of evens out the rent rates that you have, and you're kind of just getting a flat rate over the long term. But with these, you want to be able to get more money later. You're kind of making that initial investment now, and then looking for that payoff later when you actually need that money. Maybe you're retiring, maybe you want that money to live off of later in life. So what you really want to focus on when you're young or when you're in the early stages of building a portfolio is that growth. Don't just focus on that initial dividend yield. Focus on what that dividend yield could be 20 years from now, 30 years from now, when you're still holding that and have built your position to something that is very massive. So that's what I've got for you guys on DGRW. And lastly, we're going to talk about one of the biggest positions in my portfolio, VOO. I have 3 shares here for about $750. I have 4 shares of SPY, so that kind of totals about like $1,700, $1,800 worth of just S&P 500 index fund ETFs. So as you guys know, this one I believe has the lowest expense ratio out of all S&P 500 ETFs. If you guys could find me a one that has a lower, put it in the comments. Maybe I'll consider investing in that instead. But at 0.04%, it's really hard to beat this. It's really performed well over the last 5 years. Let's see where we started. From 147 to 244. So everybody's up who has owned this over the last 5 years, about $100 per share, which is really hard to beat. It's really just a simple put your money in, don't worry about it again, because the S&P 500 is a collection of the best stocks in the world, really, the American market. And as long as the American market's doing well, the S&P 500 is going to be doing well. Let's look at its top holdings. That's going to be Apple, Microsoft, Amazon, Facebook, JP Morgan, Berkshire Hathaway, Johnson & Johnson, Google Class A and C, and then ExxonMobil. So these are the biggest companies in the world, and it's kind of weighted by market cap, I believe. So this is one that I think is going to be my core position, and then I kind of supplement that with some individual stocks, some other more specified ETFs with the monthly pairs like DGRW, and a little bit of SPHD, VYM for quarterly dividends, and then VOO just holds down the middle. Nothing fancy. It's not going to give you a 50% return in a year like some stocks may do, but it's also very unlikely that you're going to lose 50% a year. Well, it's possible. It's happened in the past, but it's gonna come back with the markets. There might be a market crash, and that'll cause the S&P 500 to go down, but it's not like the fundamentals of the S&P 500 are just going to get absolutely eroded. But what's more likely to see is that there's a huge sell-off if that happens, and then that's a buying opportunity, and it's going to bounce back. It's not like a risky pharmaceutical stock that goes down 50% and never comes back, because the fundamentals of its business just aren't good enough for a higher valuation. So that's what I've got for you guys today. I hope you've enjoyed this video. If you haven't yet, just hit that subscribe button down below. If you don't enjoy the videos after a couple more, just unsubscribe. Most of our viewers watch the whole video and then have not clicked that subscribe button yet. So so just give it a try. Also hit that bell button and that like button while you're down there. Might as well. All right, I hope you guys enjoyed this video, and I will see you in the next one. Thanks for watching.